Hello and welcome to the Capital Markets Live. I'm Alvin Lam, Managing Director of International Markets at Ginnie Mae. Today I'm joined by Deborah Jones, Senior Vice President and Director of Mortgage Capital Markets at Citizens Bank. Deb oversees pipeline hedging, trading, pricing, product development, investor relations, loan delivery, repurchases, and strategic balance sheet transactions. Deb is very active in the mortgage market, including the Mortgage Bankers Associations, where she chairs the secondary market committee. She also participates on the Residential Board of Governors, Housing Policy Council, and other lender advisory boards. She has been president of her local Mortgage Bankers Association chapter and was named 2001 Virginia Mortgage Banker of the Year. She's also a great supporter for the Habitat for Humanity. So glad to have you, Deb.
Alvin, thank you very much for inviting me. I'm really happy to be here.
Let's start with the topic in everybody's mind, the interest rate. The Federal Reserve announced in its March meeting about its first federal funds rate hike since 2018. Between a strong jobs market and the soaring inflation, the Fed is returning monetary policy to a more neutral level. What do you see the Fed delivering as additional rate increases and the timing of these increases this year in its effort to control inflation?
Yeah, this will be fluid, based on the myriad of challenges the Fed is facing with the geopolitical issues, inflation, of course, that's top of mind, and the political or potential risks associated with squelching inflation hard and fast. We've been seeing messaging shift from the early March timeframe where they were initially signaling maybe about 6 moves at 25 basis points each to get to the 1.75% target by end of year. And now we're seeing this shift over to 3 near-term 50 basis point moves. So there's your hard and fast comment. And then maybe an additional 3 25 basis point moves to reach 275 by the end of the year. I think the continued high inflationary numbers have the Fed signaling a much higher rate forecast, with the market worried that the Fed is perhaps behind and some inflation will be permanent. And as such, I think the market's building this in, the 75 basis points more realistically. We probably see the first move coming here in May at 50 basis points. This is why we've seen some of the curve flattening as well. The other concerns are the Fed could be going too hard and fast, and that could tip us into a recession.
Okay, so based on your assessment on the interest rate moves, what would be your expectations for the 2-year, 5-year, 10-year Treasury yields to end 2022 and to possibly see inverted yield curves across the entire U.S. Treasury space?
After seeing a temporary 2-year spread inversion in late March and early April, spreads widened the long end, feeling that maybe they're behind or ahead right now. But I still think this is volatile. I think we're going to see some of this flattening, inversion, steepening as the market tries to find its way. So, outside of Fed changing their thoughts, I think the year end could stay relatively flat with the 2-year Treasury near 275. A 5-year Treasury at 2.875 and the 10-year around 3. If inflation comes in lower, though, you could see the short end of the curve rally, as we've seen some in recent weeks. Again, some of this positive days, negative days, more negative, obviously, than positive. But it usually takes 8 to 12 months to see inflation subside. The market has the aggressive Fed moves built in. If the Fed has to move this quickly, then it's going to be a really hard landing. Where you see the long end rallying is if the Fed's deep, fast moves get results sooner. So any signs of economic recovery, such as GDP slowing down, I think a lot of the news is going to create a market reactivity that's much more sensitive than the past. The Fed may readjust their moves as they try to tamp down inflation without slowing growth. The biggest difference from the last tightening period is the Fed can't step the changes gradually to get inflation down. If war ends, oil may come down, but commodity and food prices may stay high, as it's doubtful sanctions will come down as quickly, and supply chain issues are still very challenging.
Indeed, we're facing a lot of uncertainties. Very helpful insight. Let's talk about the Fed's balance sheet and the mortgages. The Fed has stated that it has made excellent progress on the parameters or plan to shrink its balance sheet. What are your thoughts about the Fed's recent announcement and the plan around the quantitative tightening and your guidance, both the size of the caps and the phase-in period?
Yeah, the mortgage portion of the balance sheet is about 1.5 times as large as in 2018. Their focus to shrink the balance sheet is already underway, as we know. But they've started with that 25 basis point March increase and signaled higher subsequent moves, as we discussed earlier. The second step to this was this discontinuation of growing the balance sheet as they seize those purchases for growth in March. And now the next step that kind of came out in the April minutes is to manage reinvestments of a runoff for a cap of about 35 million in mortgage backs and 60 billion in treasuries, and winding that down over time. However, with rising rates, the risk is slower runoff. And thus they've signaled it may require them selling mortgage-backed securities to shrink the balance sheet. And that's something we don't often see the Fed do. Caps are going to be smaller and phase in faster than last time, like in QE3 in 2013, where they were a little slower. So we'd expect to see them selling MBS to try to shrink the MBS portfolio faster than treasuries. And that's really where I think people are focused. Okay, we understand you stopped buying. We understand you're going to cap your reinvestments. But the real question will be, if and when will they have to sell?
Good point. Breakdown through the coupon stack shows that 2 and 2.5 are contributing mainly to the Fed portfolio pay down. What are your expectations for coupon breakdowns and the Fed portfolio balance change by coupon over the course of the next year?
Well, we've seen the Fed move their purchases up the coupon stack as rates have risen quickly, but the impact will be muted given how quickly they are reducing their purchases. They'll likely purchase the 2.5s to 3.5s versus the 4 and 4.5s current coupons, and that's rising even since I kind of talked about this topic with you all originally. Now we're seeing higher rates and coupons, but those are less liquid than higher coupons, given this sharp, fast rise in rates. So they'll focus in that middle stack there, I think. If the Fed needs to sell because the slowdown in payoffs, they're likely going to sell the 2 to 2.5s to make a meaningful reduction in the balance sheet, given the large percentage of these coupons are on their book from this long period of low interest rates that we've had. So when they sell, they'll be taking money out of the system and have the intended effect of slowing inflation, but at a very discounted price to where they purchase the assets. So that's part of this whole interesting conundrum that they're facing.
Thank you. The market participants have stated seeing catalysts for agency MBS spread widening, with the three most obvious ones being continued geopolitical uncertainty, the outlook for inflation, and the actual reduction of the Fed balance sheets. What are your thoughts related to agency MBS spreads and the investors' expectations?
Spreads have widened, give or take 50, 60 basis points so far this year, with the continued volatility and the Fed discontinuing purchases to grow the balance sheet. We should generally expect to see the widening sustain or expand. If the Fed starts selling MBS to accelerate contraction of the balance sheet, we'll see even further widening. Investors' expectations are focused on what the Fed's going to end up doing and the potential of an inverted yield curve. Banks are buyers of MBS, especially where these wider spreads exist, but with inverted yield curve, that may slow down some of the bank investments with MBS. So I think watching this market's volatility and this yield curve kind of wave up and down a little bit is going to be where everybody's focus will lie for the next several months, I'm sure, if not longer.
Yes, agree. How do you think the investors' sentiment is changing the movement in agency MBS coupon stack?
Well, the coupon stack has steepened without the Fed buying in the lower coupons. Investors have significantly increased hedge ratios on mortgages as volatility has increased and prepayment speed expectations decrease. Where differences in at-the-money coupons were as tight as about a little over a point at year end, we've seen recent at-the-money coupon spreads widening to 2 points or more without the Fed's daily purchases. So in addition, with the significant rise in rates, we should expect to see continued dislocation in the coupon stack from higher rolls to wider bid offer spreads as liquidity needs to improve in these higher coupons. And right now that just doesn't exist because of this fast, sharp rise in rates.
The Fed currently holds about 35% of the total MBS outstanding balance. What is your estimation of the Fed agency MBS paydown and how the total net supply and demand would change among domestic and overseas institutional investors by the end of this year?
The Fed hasn't really signaled what is ideal. The speculation is that the Fed will want to cut its balance sheet as a percentage of GDP from maybe 36% to 31% by the end of 2022. The challenge is, given the current size of the balance sheet, just below $9 trillion, that nothing of this scale has ever been attempted, and taking that much liquidity out of the system so quickly will have investors stepping away given this volatility. Ginnie Mae bonds have faster prepays and typically are attractive because of AAA rating and wider spreads. These are of great interest to investors, particularly foreign investors. The Fed is going to see the Ginnie Mae book pay faster relative to the UMBS, is really what I'm saying. However, with overall slowdown of payoffs run down, the Fed may have to sell the UMBS to shrink the balance sheet. Thus, the investor appetite may not be as robust as they would be, if they had a greater supply of Ginnie Mae securities in the market, which they prefer. So we'll have to wait and see on this one as well.
Yeah, it's a great insight to the investors. Deb, you have covered a very wide range of issues today. Would you like to give us a summation of current market environment?
Well, it certainly changes by the minute. We've seen that for sure. We're in an unprecedented market. We've seen lots of different market cycles. This one's definitely got a different twist to it, with the very fast, steep increase in rates and significant volatility. And, let me just give a little recap of the last several weeks' reactions to various news and events to kind of drive this point home. Early April 5th to be exact, Brainerd sent the market tumbling with no real news, new news, I should say, ahead of the official Fed minutes. I think investors were surprised she delivered the message. She's more dovish. So did that signal the other board governors were even more hawkish? So the market reacted to that, just reading into the fact that she delivered a little bit of the same news. And then the next day, the Fed minutes came out with its targeted caps on reinvestments, signaled a possible wild card of eventually needing to sell MBS given slower runoff. And the market held in, fairly well because they built that in. But then the next couple of days, the market really surged higher. April 8th through the 11th, where the 10-year reached the then recent high of about 2.82. And Japan was a big driver of that as well because they were a heavy seller. Then on 4/12, we surprisingly saw the market rally despite a strong 8.5% CPI, the highest level since 1981. The 10-year's been now hovering around 270 and even recently almost at 3% in this last few days, as investors just watch the various news components coming out on many fronts. So I would say that over the last many weeks, the market's been watching a few days of ground holding or gains, which create pockets of hope, only to be dashed by other news and surge higher. The Fed is solving for a lot, there's no question. And when you think about the balance sheet growing and growing exponentially in a short period of time, how do we manage this going forward? So, we're 10 plus years past the Great Recession, have had several elongated refinancing booms, the last being unprecedented, as we know, driven by the pandemic, that really created a lot of this inflation, to now facing the geopolitical crisis and even the possibility of stagflation. So it's going to be not only a bumpy ride and a hard landing, but a very narrow, short runway to do so and achieve the goals of reducing inflation while continuing to see a growing economy and avoid recession. The Fed is sending messages, I think, to the market about more aggressive rate moves, probably to give themselves some room to back off and adjust based on what direction many of these influencing factors may go. They've doubled their balance sheet in 2 years, but that doesn't give them capacity if the market slows down. So really interesting times, very choppy markets, But we'll just have to wait and see what the variety of news from the various factors influencing the rate market and what they're going to temper it to the best of their ability.
Well, indeed, this is the world is changing so rapidly these days. Deb, I really appreciate that you could join us today and share your very thoughtful advice. That is all the time we have today. On behalf of Ginnie Mae, I want to thank you for your time and sharing thoughts on the course of the Fed policy and the market movement.
Well, thank you very much. I enjoyed it. This is, I have to say, one of the more interesting times as a mortgage banker, and it'll be more interesting to see the outcome. So thank you for having me.
I look forward to talking to you again. That was Deborah Jones, Senior Vice President and Director of Mortgage Capital Markets at Citizens Bank. If you enjoyed this podcast, be sure to subscribe our future episodes of Capital Markets Live on YouTube. If you have any comments or questions about today's episode or other topics, please send us an email at ocmglobalinvestorinquiries@hub.gov. Again, the email is ocmglobalinvestorinquiries@hud.gov. Thank you for listening.